Good morning, Bob from Trade Genius here. It's the 4th of March, and I don't have too many charts to show you right now. I have an event I have to attend to today, but when I get back, I'll pound out a bunch of other pieces of information just to keep waving the flag that the end is nigh, and that it's not even so much about the stock market anymore. I think these the Fed and the power elite and central bankers around the world, their absolute greed and rabid grip on power has broken the system. And I'll just show you chart after chart after chart of some economic data that's proving it out. And the stock market is going to reflect that soon in probably pretty horrible ways. Do you ever see the movie The Hunt for Red October, when the Russian shoots a torpedo to kill the Americans, but the torpedo turns around and detonates his own boat, and that's what the Fed is just about to do here. They allowed the banks and the hedge funds and other central banks around the world to just pump the world with free credit to very few people who don't need the credit to do anything productive with it other than to lift asset prices. And the only reason why they're lifting asset prices is because the bank and their collateral and their balance sheets are requiring it, because incomes around the world cannot support the debts that are on the books. And now, for some perverse reason, our Federal Reserve has decided that a strong dollar is a really good policy, and that in doing so, they're killing our manufacturing, they're killing our farms, they're killing our miners, and they're creating a flow of capital into this country that can't go into anything productive, so it goes into the stock market. And my theory on it is really quite simple. It's that the the European banks are basically dead, and our Federal Reserve, since I believe it's run by the Europeans, not by the Americans, is that they're shifting these cash flows, this credit, the income streams from the reserve payments to these European banks to keep the European elites alive. And it's get to a point where it's starting to break everywhere. You have just saw inflation data from Germany, highest ever, and the Germans are probably starting to freak out. Spain had 6.8% year over year inflation, and that's before all these food prices are going to come spike them. China is freaking out. They're trying to prick their bubbles that they've created in housing and in their base commodity marketplaces, and Japan, Japan, they just constantly are creating yen, and now the imbalances are just enormous, and it's gonna cause some great dislocations, and it has to swing back. There's nothing free, and I think we saw it on Friday, and I'll show you the FXY chart here in a second. But I wanted to talk about SPY. And by the way, thank you for letting me have my little preamble. It's just so frustrating that you tend to be 4 to 6 months ahead of what's going to happen because you could see it. Is that? But you have to be prepared if you're a long-term investor. I don't care. I'm in and out of the market every day, so I'm in cash right now, pretty much, except for a few strategic stocks that I own. But most of my money is liquid, and but other people have their money with these hedge funds and mutual funds and pension funds, and you need to allocate. And that's, I'm speaking to you as much as anybody else, is that you're as good as it gets right now. And if you look at the SPY chart I have up here, this is a weekly SPY chart, and I'm going to explain a few things. Is this color band here? This is increasing distance from a price volume band. This is really what I like to call home base. This is the average price where most of the volume of the trades have been transacted. And that is where, you know, I like to call it fair value, in the sense that that's where most of the traders over the last 100 trading days, the way I have it set up, considers to be a place where we can call that fair value. And since the election, we lifted off of, and you could be 1 or 2% above and below, happens a lot, but you touch it a lot. If you get too far below it, it comes up. Get too far above it, comes back down, and then since the election, it has gone stratospheric. So this is 10% away from this. This kind of unheard of to be this far away. This means that this move here has been pushed on ever decreasing volumes. And I think there's some breadth charts that say an ever decreasing amount of stocks. And the only thing that's really amazing to me is that nobody's selling. So it's a little bit like a cartel. You have the central banks and the big five banks control most of the trading. You know, they can for at least a short-term period of time drive direction. And for whatever reason is that they drove this market from basically the yearly pivot to the R1 pivot. And it's just out of bounds. So this move here from February to here is on a 36% annualized path. Okay, so for perspective, the stock market typically grows at the same rate GDP. All right, and so you have a GDP that's growing 1.4%. It's never gone, I think, since Obama been in office, I don't think it's ever gone over 2% for 8 years. And then this February, when China was melted down, for some reason they thought stock market should be 35% higher in a year on GDP that's falling again. Okay, and then since the election, you know, at the top it was a 65%. Toward the end of the week, it was basically 56% growth rate. Again, these are unsustainable moves. And what typically happens in these moves is that once the money flow comes out and people ring the bell, and we had what's called an R1 pivot hit on the futures market on Wednesday. That's why you've seen the sell-off the last 2 days, is that's a standard deviation away from the basically the average of the high, low, and close of last year. And typically when it fails, if you get below 1% of that failure, it'll come all the way back down. And that back down happens just ironically to be right where VWAP is. So you have also what's called a kind of Eiffel Tower effect. So, you know, this move here typically gets retraced when it's considered a bubble. Okay. And the reason for my caution here is that once money flow gets above 80 here and you get a crossover, is that these moves, these crossovers that you see here, at least since this bubble phase has started, has been 5%, 2%, 5%, and this move down to where I think we're going to at least get down to these to the trend dot area here. This is 5%. And if you get it down to here, which I think is going to happen, is that we'll lose the whole thing. This will be a potential. Here, let's not guess. I'll just tell you. You know, 13% move down. So I think that's absolutely, in the cards. And we're coming up with some really interesting inflection points coming up. You know, we have the debt ceiling issues. We have the elections in Europe. We have our Fed meeting, which I think they're calling for an increase for sure now. And then we have the earnings reports coming up for the end of first quarter, which is a also a lockout period for the buybacks. So my call is, and I said this before if you check back earlier videos, is that I always said that the top's going to come at 240, 241, and we hit just in that area. And the reason why is I was looking at those pivots, and I said if it pushes over and it breaks out of this consolidation range, that's where it's going to go, and it did. So now I'm calling for this move basically to come all the way back down, because you can't keep raising interest rates and you can't keep having the dollar do what it does and not cause severe earnings impacts on our biggest companies, and it's coming. And what's interesting to me is if you look at FXY on Friday, the Fed all it said for sure said, hey, we're going to raise rates for sure. Okay, and look at this. You have the yen popped. The yen should have fallen. He fell. Great English. The yen should have fallen, but yet it popped. And when that happened, check this out. Silver started to retrace. This was an ambush. It took it down to the trend dots, and it was getting a little ahead of itself too. If silver can come down to here and still be just fine, but on a Friday, you typically, when you have news like that, I would have expected them to take this thing all the way down to the VWAP, be done with it. But the market turned on metals, and that should be an awakening. So I think the dislocations are coming, and we should see some tremors next 2 weeks, and then if we're not significantly lower by the 25th of April, then I don't understand this market anymore. But I think the market's in trouble. So anyway, I rambled on enough. I'm going to show you some other stuff later today. You guys have a great one. This is Bob from Trade Genius. I'll talk to you later. Bye.